Hi, my name is Hannah, and today we have our US tax expert, Derren, and we also have our US real estate and legal expert, Jay, and we will be discussing investment structure. Hai, nama saya Hannah, dan hari ini kami memiliki pakar pajak Amerika Serikat kami, Derren. Kami juga memiliki pakar real estate dan hukum Amerika Serikat kami, Jay, dan kami akan membahas struktur investasi.
This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HCJ.tax.
Good evening, Jay. How are you?
Great. How are you doing?
I'm pretty good. Good to talk with you again and continue this great series that we're doing. So,
absolutely.
Well, I'll let you start first. Please introduce yourself.
Sure. My name is Jay Knight. I am an American citizen that is living and working in Indonesia. I'm a licensed real estate broker in California, and I still have business operations going on out there, but also doing real estate out here as well. So that's a little bit about my background, and yeah.
Okay. My name is Derren Joseph. I am an international tax consultant, and my team specialty is U.S. international tax. And today we're going to get into the third installment in our series on investing in U.S. real estate for Asian investors. And of course, like we've said previously, sorry, we have to give the usual disclaimer. We are not giving tax advice. Maybe a tax advisor, but I'm not your tax advisor. Jim may be a real estate broker and legal advisor, but he's not yours. So we're just having a general conversation around general principles, which we may hope that would guide your conversation with whoever you retain to advise you on your real estate journey. So with that in mind, I think Jay has some questions for me.
Absolutely. Yeah. So let's just dive right into it. So we've talked already in the past a little bit about real estate and what the transactions are and how the buildup for it is and all the things that we need to do. So let's talk a little bit about how we hold property if we're going to buy from overseas. So should an overseas or an Asian investor hold property in their personal name, or how should they hold the property?
That's a great question. And with all of these things, like one size does not fit all. But having said that, as a general rule, we really advise against people holding things in their own name. Not necessarily for any tax advantage, although there may be a tax advantage, but it's more in terms of liability, because even though we spend a lot of time talking about international tax or US taxes, there's also like a protection element, because we work with our clients to protect their investments. And unfortunately or not, as everyone knows, the US is a very litigious society. So you need to protect yourself. And this is protection against what we call inside liabilities or risk. So there's inside protection and there's outside protection. What I mean by inside protection is, your tenant, because it's a rental property, your tenant may slip and fall, or they may find mold, and they say mold is gold, right? You might have a problem where you may have a legal misunderstanding or dispute with your tenant, and you would benefit from having an entity between yourself and the tenant, so that when legal action is taken, the potential liability is limited to your investment in that particular property, as opposed to your complete net worth, which is what ultimately they may come after. So that's the inside part. And then the outside part, because you may be, I'm sure you in this to be successful, and you may have multiple properties. And if there's an issue with one property in San Francisco, you don't want it to impact on the property that you have in New York. So you may want to isolate them by having them in separate entities. So although we don't say one size fits all, I think it's fairly safe to say that we advise against holding things in your own name.
Absolutely. Yeah. And I guess just to follow up on that, if you do hold it in your own name, what would be the biggest disadvantage of that?
Well,
what would be the biggest potential risk?
I think the biggest potential risk is that if in the event there's some sort of legal dispute in the U.S., someone can come after you personally, and that's your complete net worth. So that would be not just that particular real estate investment, but potentially all your real estate investments in the U.S., or even your assets back in Indonesia, Malaysia, Singapore. So, I mean, if they wanted to go all the way, they could, because it's in your own name, and you are personally liable should anything happen. In addition to which, there's also the idea of U.S. taxes. So typically, it presents no advantage to hold it in an entity from an income tax perspective, but potentially from a transfer tax perspective. And here we're talking about specifically U.S. estate taxes. Unfortunately, at some point in time, we're all going to pass away. And if it is that you hold your U.S. real estate investment in your name, it could present U.S. estate tax liability when it goes through the probate process and is passed on to beneficiary, wife, husband, kids, siblings, or whatever your wishes are. There could be a liability which could be mitigated if you were to hold it through a structure.
Yeah, so I mean, let's say you had a net worth of $10 million and you hold a property in your own name and you get sued, you put your whole net worth at risk, right? So it's a huge liability. Yeah.
Absolutely.
All right. We don't want to do that. So what about holding the property in some sort of Asian entity? Say you have an entity in Indonesia. I mean, would that be a good idea?
You could, and people do. We have Indonesian investors who decided to hold it in the name of their PT or through an entity in Singapore or whatever. But I see a number of downsides to that, one of which is taxes. Because it's a foreign entity, there are certain additional tax burdens which may result, and there's something called the branch profits tax, which I probably won't get into right now, but what I'll summarize it to say is that you may pay more taxes than you could with alternative structures. You may. And then the second thing is around privacy. Just like holding it in your own name, the idea is just to keep your personal affairs personal. And you may not want the tenant or anyone in the US to know that the ultimate owner is a family in Indonesia or in Singapore. You don't want anyone to get ideas. You just, maybe your company, the company that you use may be well known, and you don't want people to know who you are. So there's nothing wrong with being private. In fact, under certain circumstances, it can be a good thing. So in short, I think for certain potential tax reasons, as well as just privacy, I would advise, typically, some cases it may make sense depending on what your overall portfolio, what your overall objectives are. But generally speaking, holding it in a foreign entity, particularly an Asian one, not always a good idea.
Okay, fair enough. What about different types of entities in the United States, like an LLC? Maybe you can talk a little bit and explain a little bit what an LLC is and what would be the benefits of holding something in an LLC.
Yeah, so the LLC is a strange creature in law, which is really tricky to explain to those who are not from the US, because there's no direct equivalent in Indonesia, Singapore, Malaysia. But suffice it to say that in the US, it is a republic, and so you have the federal law, and then you have state law, which I guess is, to be fair, is not so different from, say, Malaysia, which is also a federation. So there's some similarities there. So under US law, the states have the ability to recognize and incorporate entities. But when you do that, the federal government does not know how to interpret it. So if it is that you form an LLC and you're one person, or maybe your family, so husband and wife, then it's an LLC, so it's a limited liability company at the state level. So it's like a PT in Malaysia, or private limited in Singapore, or Sendirian Berhad in Malaysia at the state level. But at the federal level, it's less clear. So if it's a husband and wife, the federal government will need to understand, okay, do you want this to be treated like a partnership because there are two of you? Or do you want it to be treated like a limited liability company, a company limited in its liability? So do you want it to be a pass-through, or do you want it to be a separate legal person? And the federal government needs to understand that. Similarly, if you're just like one person, a one-person investor, and you form the LLC at the state level, yes, it's a limited liability company, but at the federal level, the federal government wants to know, okay, is this a pass-through? Are you trying to do this as a sole proprietor, or do you want to be a company? So you need to make that distinction. In addition to which, remember we're saying that you need to form it first at the state level. There's this hybrid thing. So you need to understand which state. Because everyone says, oh, US LLC, Delaware. And the reason why, Delaware has stood the test of time, it has great statutes on its books which work in favor of investors or employers or business owners, as opposed to some states which may sometimes lean towards creditors or potential employees and stuff like that. So it offers great protection on the side of the investor. So we get Delaware, but you lose that protection if you were to form a Delaware LLC and then try to buy and operate buy and operate real estate in California, New York. Then in fact you've neutralized or neutered your Delaware, the strength of the Delaware LLC, and you now have a California LLC. So there are two things. The point is that this is not a simple process, and you should definitely take legal advice because of the whole thing of state versus federal, and depending on who you are and what your investment strategy is and what the nature of your portfolio is. One structure may be more efficient than others. And then different states have different rules. And depending on where your real estate is located, you would need to have an LLC in that, or an entity in that state to do business, with permission to do business. But you should also be looking at an umbrella structure that offers even though it may be a California property, you can still have something, or you may have a California LLC, but that is protected above it by the Delaware LLC. So those kind of structures offer maximum tax efficiency, maximum anonymity, and protection against potential liabilities.
All right, that's a great answer. Now, one thing maybe you just can go a little bit further in, just so people that are listening are clear, is you mentioned about a pass-through. Maybe you could explain what that means, so for people that are not familiar with that term, what that actually means.
Yeah, this is really kind of confusing in that you have formed a limited liability company at the state level, but you need to explain to the federal government by filling out a form that basically an entity classification form. How do you want this LLC, which you formed at the state, to be treated by the federal government? And if you don't say anything, the default is a pass-through. So the equivalent in like Malaysia, Singapore, and Indonesia would be, if it's one person, a sole proprietor. So you just have a business in your own name. So even though it's an LLC, if you don't say anything, because it's just you, the federal government says, well, he hasn't said anything, so maybe he's just in his own name, and that's it. So it's a pass-through. So it passes through to you personally, which is where we were in the previous question. It passes through to you with all the strengths and weaknesses that entails. And if it's two or more of you, then when we say pass-through, then it's a partnership. So, and again, well, we have partnerships in Indonesia and in Southeast Asia. So We know what a partnership is. And again, you don't, at the federal level, you've told, by not saying anything or electing in that favor, you've told the federal government, you know what, I'm ultimately responsible. So I don't want any protection in between myself and my investment. It's just me, which sometimes can make sense. Sometimes it's part of a structure that does make sense, but on its own, we don't always advise that.
All right, great. That's makes a lot of sense, and hopefully that will clear that up for anybody who was not familiar with what pass-through meant. So let's take it a little step further. So if you were looking to invest, mm-hmm. and you think LLC is the way to go, is there a cheap way that you could set up an LLC in America and for under $100, or how does that normally work?
Absolutely, and that's the thing. There's so much information on the internet, and that's why we say don't take legal and tax advice from the internet. Don't take legal and tax advice from us. What we're trying to do is give you questions that you can ask the advisor that you eventually engage. So you want to engage someone who understands your situation. You cannot look at a guy on YouTube. You can't listen to a podcast. You can't read an article or look at some group in not Yahoo or LinkedIn or in Facebook especially. And because this one guy or lady, it worked for him or her, assume that it works for you. And there are people that there are businesses out there, they're like LLC mills. They just churn out thousands of LLCs a week, if not per day. I don't know. And it's based on the premise that one size fits all, which we've just established certainly does not. So to be clear, a lot of the problems that a lot of the businesses we do in this space is cleaning up past mistakes. So someone thought, you know what, I've done a PT in Indonesia on my own. I've done my Singapore Private Limited. It's so easy. I've done my Sendirian Berhad in Malaysia. I don't need any help. I know how this stuff works. I'm educated. I'm a successful entrepreneur, business owner. I don't need to pay for this. I could save some money.
Right.
But it tends to bite you, and and you need to deal with it later on when you create this. So there are always unintended consequences of going in cheap. So either you pay on the front side or you pay on the back side. Up to you.
Very true. Very true. All right. So let's talk a little bit about the tax side. This is not really your specialty. So maybe you can give us some enlightenment regarding the taxes.
And the U.S. system is, as everyone knows, right? Because once you have any taste in the media, you see movies, you know that the tax system is unusually complex. And some argue that it's the most complex in the world. Some people say Brazil, but some people say the U.S. But it does take some getting used to, and it is unusually difficult to navigate. So I've never seen someone from the outside who maybe has, if you've gone to like university in the US or maybe you work with a multinational, maybe you're kind of familiar with it. But if you're just cold walking in, I have not seen anyone really figure it out. So it's huge. I mean, at the federal level, it's like 8 million words. It's a tax code and growing. And then you have 50 states, and each tax code within each state is in the millions of words as well. So we're not going to explain this in 5 minutes, but just summarizing, just really, really high level, you have probably like 4 levels of taxes. You have the federal tax, which is from Washington, D.C., for that's like at the national level, at federal level, as we say. And then states have taxing rights as well. So if you're in California, if you're in New York, then the state of New York will tax you in whatever rental income you may have, or when you sell, and you sell it for more than you paid for it, that difference, you pay taxes on that as well. And then at the city level, you may have taxes as well. So for the city of New York, using the New York example, so that's a 3rd level. So you have federal, state of New York, city of New York. So that's 3 levels so far. And then you may have county level taxes. So let's say you in a particular locality, that locality may have the ability to levy taxes, and that may just be a property tax, which is levied not on the income you earn from the property, but just the value of it. There's a rateable value. and whatever, and there's a calculation based on that, and that may be the fourth level of tax you pay. So so and that has obviously that has implications, right? Because when you go in, and you're going in, you're a smart investor, you've made money in your home country in Asia, so you know how to assess risks and opportunities. And you may have like a spreadsheet to figure out your rental yield, especially one of those, if you're one of those that have done one of the many courses or whatever. You may get a sense for, you can Google, you can see how much it costs, you can, well, you're putting in all cash, you don't need to worry about interest. Although you may want to structure it in such a way that you lend yourself the money, which is a different conversation. But you know what the expected rental yield would be, and then you think, hey, you know what, I can make money on this. Not remembering that taxes are due. And taxes could, you know, tilt the scale from something that is a double attractive investment to something that is not. So that's on the income side. Now, what people also forget about would be, depending on how you hold it, you may be subject to estate taxes, which is, for the want of a better word, is like a death tax. So if you hold it in your own name, or if you hold it under certain structures, when you pass away, unfortunately, before it goes to your next of kin, like your spouse or your kids or whatever, and a tax may be due on that estate, and it may again be due at the federal level depending on how much it is, and it may be due at the state level as well, so it may be hit twice, and those taxes tend to be pretty high. So that's definitely something you want to consider, especially if you have a long-term, like a buy and hold strategy, and you tend to just look at it as rental yield as opposed to flipping it. Something to think about.
Sounds pretty expensive to die.
in the US, if you're not prepared, everything gets expensive. But if you prepare, it's manageable.
Okay, well, that's good to know. You said there's federal tax and state tax. I'm like, hey, goodness. So, all right. So, you know, we talked about LLC, right? We talked about estate tax and different taxes. Maybe we can talk a little bit, and you can explain a little bit the difference between an S Corp and a C Corp and how those and taxes kind of interrelate.
All right. So for the most part, this is like an academic discussion, because one of the limitations of an S Corp is that it's, foreigners aren't allowed. So non-US persons can't be an owner or shareholder, depending on how you look at it, in an S Corp. But essentially, the S Corp is like an entity that's kind of in between an LLC and a C Corp. So it's like the in-between guy. So, you know, depending on who you are and depending on your exposure tax-wise, there may be some higher tax liabilities when you use an LLC, which could be mitigated if you were using an S Corp. So it'll go down a bit. And, you know, but of course, this is not relevant to a foreign investor audience, but if you're a US person, it's definitely something to consider. So really the conversation is about an LLC versus a C Corp. So a C Corp would be a regular company, like, for example, like Facebook or Zoom, or, you know, whether it be publicly listed or privately held. It basically is telling the federal government that I want a higher level of protection between myself and this entity, that this entity is definitely a separate legal person from myself. And there so that wall, because we spoke about protection and the need for protection, just generally speaking, a C Corp gives you a high level of protection, but there are also different tax consequences to consider. So essentially, depending on how you structure it, you may pay tax twice on the same income, at least at the federal level we're talking about. This is because the entity, because it's a separate legal person in law at the federal level, it prepares its own tax returns and pays its own taxes, which is something you're familiar with, because that's what a private limited does in Singapore. That's what a PT or PTMA, PMA does in Indonesia and so on. So that's normal. But whereas, like, say, in Malaysia and Singapore, the dividends may not be taxable. The dividends would be taxable in the US. So in other words, that same money may be taxed twice, once by the company pays taxes, and then when you receive it as dividends, you pay taxes as well. But again, depending on what your strategy or structure is, especially if you want to venture into commercial real estate as opposed to residential, it is something that's worth considering and worth understanding in greater detail to see if it's relevant to you. It may be.
Yeah. All right. And for those of you that don't know, the difference between commercial real estate and residential is simply that if you buy a building that is over 4 units or 4 units and more, then it's considered to be a commercial building as opposed to a residential one. So it will also have different tax liabilities and different kinds of things like that. And also will differ in terms of how you purchase it and where you look for it and all that stuff. But we'll talk about commercial real estate on another time. So great. All right. So let's keep moving. What about, maybe you can explain to everybody a little bit about what a trust is and a foundation and how they may differ and how they kind of fit into the big scheme of things.
Sure. So foundations should be pretty well known to Indonesian-based investors because it tends to be it's a creature that's quite popular in civil law jurisdictions like Indonesia, whereas a trust is more popular in common law jurisdictions, and it's actually not recognized in civil law jurisdictions anyway. So Singapore and Malaysia are well versed with trust law, but essentially they're different. I would say entities just for the sake of being simple, but for those of you with a legal background, you're going to say, oh, this is not an entity, and you're going to comment down below. I know that. But just for the sake of keeping it simple, it's another way of holding or structuring your real estate investment. And it may not necessarily offer tax efficiency, may or may not. So it's not necessarily a tax play, but it's often around anonymity or privacy, as well as to some extent asset protection and probate avoidance. So, because in most legal systems, as everyone knows, when someone passes, there's a process for transferring assets from to whoever the beneficiaries may be. So that helps, and these structures may help in that process. There may be some tax benefits, but those what I want to say is that somehow the media has equated trust and foundations with tax dodging. So this is tax avoidance and tax evasion, and that's not the case. It's not a tool that you should think of as synonymous. Well, that's how you get to pay no taxes, because I watched a movie and they used a trust, a foundation, and no one paid any tax. That's right. Not the intent. It may happen, but definitely that's not necessarily the intent walking in. So in short, it's another structure or a relationship, if you're talking about a trust, that allows you to hold your U.S. real estate investment. And it should be considered because it may or may not be relevant to you. So when you consult with your advisors who would know your situation inside out, that perhaps would be one of the tools that they may leverage to make sure that you're well protected.
Yeah, absolutely. And just to piggyback off that, the whole idea of the trust really is to create like you said, it should be part of your overall estate planning kind of strategy. It's not necessarily to avoid taxes, although that could be an ancillary benefit of it, but really is to be able to transfer property that you have to someone else at a later time. So basically, the trust will set up is set up for a beneficiary that you deem, and there's a trustee who's going to run the trust for the benefit of the beneficiary and have some sort of fiduciary duty to run it in their best interest. So we can talk in more in depth also about trust. What about a foundation, though? Because foundations, I know you touched on it briefly, but maybe tell us a little bit about what exactly it does and why people may want to set up a foundation if it's something that's interested to them.
Well, that one definitely offers, under certain circumstances, once it's deployed in the right way, it does offer some sort of tax benefit, and it allows you, as opposed to when you're using a trust, there are different types of trusts, obviously. And if you're using what we call a non-grantor or an irrevocable trust, basically you as the original investor may lose control, and that's part of the process. You're turning it over to a trustee, as you mentioned, Jay. Whereas a foundation allows you to remain in control. So it's a separate entity in law, but together with like a management committee of sorts, you remain involved in managing and guiding the process. So that's one of the key benefits, but it comes at a price in that it's heavily regulated. So in order to have that benefit of being recognized as a foundation, the compliance burden is pretty high. So you have to follow a lot of rules, and there's a lot of oversight by whichever jurisdiction you choose to form your foundation. If it's in the US, it might be, let's say, a 501c3. If that makes sense for you as part of your strategy, maybe it does, maybe it doesn't. But if that's in the US, just using the US as an example, to get that recognition by the Internal Revenue Service that you do have a foundation, a 501c3, which is a charitable foundation. That's a code section we use for charitable foundation. Back in the day, it used to be like 3-4 months to get that approval letter, but now it takes about a year or more. It's not unheard of, more than a year. And the IRS keeps an eye on it, and if you violate any of the smaller terms and conditions, your status could be revoked. So again, but it may make sense for you given your situation. And of course, once you take legal and tax advice, that could be worked out, whether it works for you or not.
One other thing I was going to have you touch on as well is you talked a little bit about the taxes that you're going to potentially have to pay. Yeah. And you talk about that because if you buy property in the U.S., those taxes that you are referring to are taxes that are be paid in the U.S. What about if you're an Indonesian and say you're Malaysian, Indonesian, Singaporean, Filipino, anywhere in Asia, and you buy something in the United States? Yes, you pay taxes on the property there through whatever entity or structure that you have set up. But what about paying taxes where you are in your home country? Do you also have to pay taxes there as well on the property or on the entity? Or is it totally separate?
That's a great question. And that's why we also advise that you need to have both tax and legal advice, not just from a US perspective, but also from your local perspective. And somehow they need to speak to each other, which becomes difficult if you're using someone who's based in the US. Whereas if you have a team like ours, I mean, we're not the only ones. There are others who understand both Indonesia, US, out of the same office, or Singapore, US, Malaysia, US, Philippines, US, Vietnam, US, Thailand, US, whatever. Then you have like a joined up view. And you're right. In certain jurisdictions, for example, Indonesia, very aggressive. If it is that you have a real estate portfolio overseas, yes, absolutely no doubt that is taxable in Indonesia. No doubt, because Indonesia taxes you on your worldwide income, no conversation, right? Whereas if you're in Singapore, Malaysia, it becomes a bit of a gray issue, because if it is you are managing a real estate portfolio from Malaysia, Singapore, even though Malaysia and Singapore say, well, we only tax you in the territorial on local sourced income only, the point is that you're running a real estate business or you're making decisions from Singapore, Malaysia. So technically, it should be taxable in Singapore and Malaysia. But again, with good advice, you can set up a structure that is compliant with the tax rules in Singapore and Malaysia, where you may not have to pay local taxes on the money that's made overseas. And again, I don't mean to sound like a stuck record, but that's why it's really, really, really important that on the front side that you get advice before you enter into this, to make sure that you set it up in the right way and you don't have any uncomfortable encounters with your local tax authorities.
Absolutely. Yeah, I mean, you covered a large array of taxes and entities, and I think it's been really useful and beneficial for people to kind of hear and understand this. But like you mentioned, yes, it is extremely important that you talk with a professional, especially someone that can understand and knows your situation upside, down and backwards and everything, to make sure that they give you the best advice. But yeah, it is complicated, and there are a lot of different factors and a lot of different things that you have to take into consideration. And like you said before, there's not one size that fits all. So you have to really have someone that's informative about the different types of entities, the different types of laws, and so forth and so on. So, but this has really been enlightening, and I'm really glad that we had the opportunity to kind of discuss this in greater depth. And I'm hoping that we can continue the conversation and continue to learn and continue to educate others about real estate investing from Asia to the U.S. It's a really cool topic, and let's keep it up.
Looking forward to talking about the next one. I think from the next one really gets exciting. So I'm looking forward to the next one.
Awesome, man. Great seeing you.
Likewise.